Is the hottest AI infrastructure stock on the market a screaming strong buy, or is it basically just a perfectly disguised value trap waiting to catch retail traders off guard?
Yeah, I mean, that is the multi-billion-dollar question right now. It's
Yeah.
really driving this massive wedge
Mm,
between the fundamental cash flow investors and, the momentum traders.
right.
Because the enthusiasm is blinding. But if you look under the hood, there's a pretty dangerous divergence happening below the surface.
Welcome back to the deep dive. Today we are pointing our spotlight directly at Marvell Technology Inc., ticker symbol MRVL.
A really fascinating one to look at right now.
Oh, absolutely. Let me just set the stage for you. As of yesterday, April 21st, 2026, this stock is riding this violent, almost vertical bullish trend.
Yeah, it closed at $151.31, right?
Exactly. Logging a 2.35% gain for the session. And in the process, it touched a brand new 52-week high of $154.95.
Which is just staggering when you map it against the fact that, just 12 months ago, this same equity was languishing at a 52-week low of $48.09.
It's wild.
That is more than a 200% expansion.
Yeah, and that kind of velocity really forces our hand. Our mission today is to tear apart the financials, the technicals, and that insider order flow to see if this surge is justified by real architecture.
Or if it's just, built on a house of cards.
Exactly. But before we unpack the numbers, make sure you like this video, subscribe to our YouTube channel, and you absolutely must leave us your feedback in the comments. We want to know if you think this stock is wildly overvalued or if the paradigm has truly shifted.
And we really have to demand proof from the financials first. When a physical hardware company triples its market cap in a single year,
It's a huge red flag.
right, we can't just coast on the momentum of the word AI. We have to verify if the actual cash being generated today matches the massive premium the market is demanding.
Okay, let's unpack this. We have the fiscal year 2026 results right in front of us.
We do.
Everyone knows Marvell is positioning itself right in the crosshairs of data center demand. But beyond the press releases, what do the ledgers actually dictate?
Well, the ledgers are showing a tectonic shift in their revenue profile. For the fiscal year 2026, annual revenue hit a record $8.195 billion.
Wow, over 8 billion.
Yeah, that is a 42% year-over-year increase. And the acceleration is heavily backloaded, meaning the momentum is peaking right now.
Oh, so the most recent quarters are doing the heavy lifting.
Exactly. The fourth quarter alone pulled in $2.219 billion.
I have to pause you there because a 42% jump in top-line revenue for a company dealing in silicon, optical interconnects, and, physical supply chains is incredibly rare.
It really is.
That's a growth rate you normally associate with a pure software as a service model, not a company manufacturing tangible data center plumbing.
And if we connect this to the bigger picture, that is precisely the premium the market is trying to price in. The bottom line is showing a massive capitalization on this whole data center bottleneck.
How massive?
Well, their GAAP net income for the fiscal year reached $2.67 billion. So we're looking at a trailing earnings per share of $3.07, with the Q4 non-GAAP EPS coming in at 80 cents.
Which basically proves the revenue isn't just some vanity metric growth. The cash is actually making it through the income statement and hitting the bank account.
Exactly. And the health of that cash flow is what gives the bulls their ammunition. Like Q4 operating cash flow with a very healthy $373.7 million.
Okay, solid.
But the most crucial metric for a hardware supplier in this space is their gross margin. And that's currently sitting at 51.02%.
Wait, really? Retaining over half the capital after accounting for the direct costs of manufacturing custom silicon?
Yep.
That is a massive signal of pricing power. You don't get 51% gross margins in hardware unless your customers have absolutely no alternative but to buy from you.
You really don't.
Yeah.
And that drops down to an operating margin of 14.80%. Plus, they haven't overly leveraged themselves to achieve this kind of scale.
So the balance sheet is clean.
Very. The balance sheet shows a debt-to-equity ratio of just 31.24%. They are financing this massive AI expansion largely through operational cash, not by burying themselves in high-interest debt.
Okay, I hear all of that. The margins are fantastic, the revenue velocity is breaking records, and the debt profile is lean.
Yeah.
But I am not buying this narrative completely without pushing back.
Yeah.
Are these numbers actually $154 a share? Great.
That is the big question.
We were talking about a stock that was 48 bucks. Is this aggressive AI demand from their Google and NVIDIA partnerships genuinely pulling enough present-day financial weight to justify a $150 price tag? Or Are investors just blindly paying any multiple for a company adjacent to AI?
This really raises an important question about the psychology of the current market, because the current price is absolutely not a reflection of the $8.195 billion they just made.
Right, it's totally divorced from that.
The market is entirely forward-looking, and it has unilaterally decided to price in Marvell's pivot to a pure-play AI infrastructure firm.
So they're buying the future.
Exactly. Investors are buying the belief that as GPU clusters scale from tens of thousands to hundreds of thousands of units, Marvell's optical interconnects are basically the only viable solution to the data bottleneck.
Okay, forward-looking is one thing, but pricing in a flawless, multi-year monopoly on AI networking architecture feels like textbook bubble behavior to me.
It definitely has those markers.
Which leads directly to the question of who is actually driving this price action. If the cash flow is strong, but the valuation requires flawless future execution, how is the actual market treating the stock today?
From a purely technical standpoint, the market is treating it with historic, almost violent aggression.
Violently bullish.
Yeah. The price is sitting at 151, which is light years above its 50-day moving average of $95.47. It is completely detached from its historical price channels.
The rubber band isn't just stretched, it's threatening to snap.
It really is. The primary warning sign flashing on the dashboard is the 14-day RSI, the Relative Strength Index.
What's that?
It's currently sitting at an extreme 97.76.
Oh my goodness. For those listening who aren't technical analysts, an RSI of 97.76 is like driving your car at 120 miles per hour while you're still stuck in first gear.
That's a great way to put it.
The momentum you are experiencing is undeniable, but the engine is absolutely screaming. A stock simply cannot sustain that level of overbought pressure in perpetuity without something giving way.
And yet VanCD is still showing a confirmed bullish crossover with an expanding histogram. So the algorithmic buying pressure is actually still accelerating.
That's terrifying.
If you look at the options order flow, retail and institutional sentiment is overwhelmingly heavily skewed, like 75% bullish.
Wow.
There's a massive wall of call volume sitting at the May 150 strikes. The street is heavily leveraged on the belief that this rally just ignores gravity through the spring.
But here is the massive glaring twist. If the options market is overwhelmingly buying and retail's out there chasing the momentum, who is providing the liquidity? Like, who is selling?
That's the billion-dollar twist.
The answer is the insiders. The very people building the architecture are taking massive chips off the table.
The recent Form 4 filings are certainly eye-opening.
To say the least. I mean, on April 15th, CEO Matthew Murphy sold roughly 7,500 shares at $134.46.
Right.
Then, the chief financial officer, Willem Meintjes, offloaded 30,000 shares at $134.01. Just 2 days after that, Executive Vice President Mark Casper dumped another 10,000 shares at $135.50.
It's a noticeable cluster.
You see that cluster of executive offloading, and it's hard not to feel like the people who actually know what the Q2 guidance looks like are cashing out, while retail traders are leveraging their portfolios to buy in.
What's fascinating here is how easily insider selling is misinterpreted during momentum supercycles. We have to detach the emotion from the structural reality of executive compensation.
Okay, play devil's advocate for me.
The vast majority of these sales are executed through 10b5-1 trading plans.
Ah, the automated plans they set up in advance.
Exactly. Insider 10b5-1 sales are less like a captain fleeing a sinking ship and more like a farmer selling a portion of their crop at a guaranteed forward price, so they can pay their mortgage regardless of what the weather does next month.
That makes sense.
These executives likely filed these plans quarters ago, setting automated trigger prices at 134 or 135. When the stock went vertical and hit those targets, the algorithms automatically executed the sales.
So it's not a panic sell.
No, it doesn't inherently mean the C-suite thinks the company is fundamentally flawed.
I understand the mechanics of a 10b5-1 plan, but let me challenge that. Sure, the execution is automated, but the executives still chose to set those specific price targets months ago.
That's true.
They looked at their own internal projections and decided, hey, if this stock ever hits 134, it is fully valued, and I want to liquidate a massive chunk of my holdings. And now, retail is buying it at 151.
Fair point.
Automated or not, it forces us to ask what the people inside the building think this stock is actually worth today compared to Wall Street.
That is a highly valid critique, and it perfectly sets up the massive valuation clash currently dominating the institutional chatter.
Let's get into it.
If we look at Wall Street's consensus, 84% of analysts are maintaining a strong buy rating. They are aggressively chasing the price action with their targets.
Yeah, RBC Capital just ratcheted their target all the way from 115 to 170. Oppenheimer is right there with them at 170, while Stifel's playing it slightly more conservative at 140.
Yep.
So from a charting perspective, the key resistance ceilings are that psychological 155 level and then the 170 upper target. Support sits at 144.50, the 140 option strike floor, and 137, which currently lines up with the 5-day moving average.
Those are the key levels to watch.
But here's where it gets really interesting. You have Wall Street analysts throwing $170 targets around based on top-line growth multiples, but that completely ignores the traditional mechanics of corporate valuation.
It totally ignores the cash flow.
Right. The bullish growth-adjusted model puts fair value right around $155.37, but if you run a conservative discounted cash flow model, a DCF, it prices Marvell's intrinsic value at just $63.37.
The disparity between 63 and 155 is the definition of a paradigm clash.
A $90 gap per share isn't a rounding error. How does a rational market tolerate a valuation that is more than double what a fundamental cash flow model dictates?
Because a discounted cash flow model and a growth-adjusted multiple are speaking two entirely different languages.
How do you mean?
Well, a DCF model is brutally pragmatic. It looks strictly at the actual cash the business is reliably expected to generate over the next 5 to 10 years, discounted back to today's present value based on the weighted average cost of capital.
So no hype allowed.
None. By those traditional cold, hard metrics, Marvell is egregiously overvalued. It has all the mathematical hallmarks of a value trap.
A trap specifically designed for retail investors who look at a positive PE ratio and record revenue and mistakenly believe they're buying a value stock with a margin of safety.
Exactly.
Entirely ignorant of the fact that the price requires 5 years of perfect, uninterrupted hyper-growth just to break even on the premium.
Exactly. But the bulls argue that the DCF model is broken because it applies historical terminal growth rates to a hardware company that is suddenly operating with the software-like margins of an AI monopoly.
So they think the old rules don't apply.
Right. By AI growth metrics, the market feels 151 is perfectly justified, maybe even slightly undervalued, if they successfully capture the entire data center interconnect market.
But that is a staggering amount of pressure. Valuing hardware stocks on projected AI paradigm shifts rather than their current cash realities requires zero friction in the macro environment.
Zero.
If that future is anything less than utopia, that $63.37 DCF value is a long, painful way down.
Which brings us to the actual risk profile and the specific events that can trigger that descent. We have to outline why retail traders so frequently get eviscerated in these exact setups.
Yes, let's talk about the downside.
The most immediate threat isn't even fundamental, it's structural. It's the trap risk.
Walk us through how the trap snaps shut.
Retail traders are heavily driven by the fear of missing out. They see the equity cross 151, they read headlines about NVIDIA and Google, and they deploy capital at the absolute apex of the momentum curve, buying into a 97 RSI.
The 120 miles per hour in first gear.
Exactly.
Yeah.
Meanwhile, the institutional funds who accumulated shares down at $50 or $80 realize the technicals are redlining. To protect their quarterly performance, those institutions trigger a controlled technical sell-off to take profits.
And because the stock is so extended, even a routine institutional profit-taking event translates to a violent 5 to 10% downward shock.
Precisely. The price rapidly compresses down to that 137 support level.
And then the panic sets in.
Yeah. The retail trader, who just bought at 151, sees their portfolio immediately bleed out, panics, and sells at a loss to stop the pain. The institutions shake out the weak hands, the technical indicators cool off, and the retail trader is left holding a massive realized loss.
It's brutal, and it happens every day. But that is just a technical shakeout. What about the actual bear case? What is the worst-case continuation scenario for Marvell's underlying business model?
The primary bear case hedges on a macroeconomic slowdown in cloud provider capital expenditures.
The spending dries up.
Right. The massive revenue spike Marvell is enjoying relies entirely on companies like Amazon, Microsoft, and Google pouring hundreds of billions into new AI infrastructure.
Yeah.
If those tech giants decide their current GPU clusters are sufficient for the next development cycle and pause their spending, Marvell's forward revenue guidance collapses overnight.
And when revenue collapses, that manageable 31% debt-to-equity ratio suddenly feels a lot heavier. especially in a macro environment where interest rates remain elevated for longer than anticipated.
Very true.
But there is a more specific execution risk here that the market seems to be completely ignoring. We need to talk about the custom ASIC chips and Alphabet.
This is perhaps the most critical vulnerability in the current valuation. The market is pricing Marvell as if they have already locked up a monopoly on custom silicon. We know they are in talks with Alphabet Google to design and manufacture custom ASICs.
And a custom ASIC is wildly different from an off-the-shelf GPU.
Completely different.
Google wants architecture explicitly designed from the ground up for their specific AI workloads to drastically reduce power consumption and bypass the massive premiums NVIDIA charges for general compute GPUs.
Exactly. If Marvell secures that contract, it is a multi-year, multi-billion-dollar moat. The problem is that the stock price is currently trading as if that ink is already dry.
But it's not.
No. The reality on the ground is that these talks are strictly exploratory. They are not finalized contracts.
Which means Broadcom, or any other major semiconductor player, is likely in the exact same room with Alphabet pitching their own custom silicon architecture.
Oh, without a doubt.
If Google decides to go with a competitor, or simply decides to continue heavily leaning on standard GPUs, Marvell doesn't just lose future revenue, they lose the entire narrative propping up that 155 fair value calculation.
The bubble pops.
The market would violently reprice the company back toward that $63 DCF model.
That is the execution tightrope they're walking. But to maintain analytical balance, we have to acknowledge why 84% of Wall Street is willing to accept that risk. The bull case for Marvell is just as compelling as the bear case is terrifying.
So what happens if they execute perfectly?
The best case continuation relies heavily on their optical interconnect revenue. As AI models scale, the bottleneck is no longer just processing power. It's the speed at which thousands of GPUs can communicate with each other across a data center without melting down.
Right, the networking.
Marvell provides the networking architecture that solves that specific data wall. If they can successfully hit their projected 50% revenue growth in that specific interconnect segment for fiscal year 2027, the underlying fundamentals will actually begin to compress that ridiculous PE multiple.
They will literally grow into their current valuation.
Yes. And the secondary pillar of the bull case is that those exploratory talks with Google convert into ironclad multi-year contracts and their existing networking integrations with NVIDIA deepen.
Setting them up as the toll booth.
If they achieve that, they effectively become the toll booth for all major AI infrastructure buildouts. The market will gladly continue to pay a massive premium for a company with that kind of entrenched monopoly.
Okay, we have covered a massive amount of ground today. We've dug into the 42% revenue acceleration, the absolute extremes of the RSI momentum, the reality behind 10b5-1 insider selling, and the canyon between a $155 growth valuation and a $63 fundamental cash flow reality.
There's a lot to process.
Let's pull this all together. What is the actual outlook for you?
We have to segment this into two distinct horizons. In the immediate short term, looking at the next few days to weeks, momentum is a powerful force.
Absolutely.
If this aggressive bullish volume holds, we can absolutely expect the stock to test that upper range of 152 to 165, challenging those higher analyst targets.
Right.
However, respecting an RSI of 97.76 is mandatory. You have to be psychologically and financially prepared for a rapid technical reversion down to that 137 support level as the indicators inevitably cool off.
And the long-term outlook.
Looking on to the end of FY 2027, the bulls have a clear line of sight to $200 a share. But let me be crystal clear. That 200 target is a perfection premium.
Everything has to go right.
It only materializes if the macro cloud spending remains relentless and the Alphabet and NVIDIA partnerships execute without a single misstep. There is absolutely zero margin for error built into this current stock price.
As a reminder to everyone listening, we love analyzing the data, we love tearing apart the technicals and the structural mechanics, but we are just two people looking at the numbers. This is a deep dive, not financial advice.
Always do your own research.
Always do your own rigorous research and understand your own risk tolerance before placing a trade in a stock with this level of volatility.
The leverage in this specific setup makes the downside risks just as magnified as the upside potential.
So what does this all mean? We started today by asking if Marvell is a strong buy or a perfectly disguised value trap. And after mapping the entire landscape, I want to leave you with one final provocative thought that goes beyond the spreadsheets.
Let's hear it.
We've talked extensively about Marvell's software-like margins and their AI data center dominance. But at the end of the day, Marvell is a fabulous semiconductor company.
Meaning they don't make the chips themselves?
Exactly. They design the chips, but they rely entirely on foundries like TSMC in Taiwan to actually manufacture them. If geopolitical tensions escalate or the physical supply chain fractures, it doesn't matter how incredible Marvell's custom ASIC designs are or how badly Google wants them.
It all stops.
If they can't physically print the silicon, does that 137 support level hold, or does the entire hardware premium evaporate overnight?
It's an existential risk that no discounted cash flow model can accurately price in.
Let us know what side of the debate you land on in the YouTube comments. Are you riding the momentum of the AI infrastructure boom, or are you staying far away from an RSI of 97? Make sure you subscribe so you never miss an analysis, and we'll catch you on the next deep dive.